I think back to when I was in the operator seat, and I'm often shocked that I never actually asked an investor, what is your goal? What return do you want out of this? And I think as operators, we should feel very comfortable asking that of investors because they're approaching that conversation with that goal in mind. And so if you can establish that goal up front, then it makes it really clear, okay, do I want to pursue that goal?
Welcome, everybody. I'm excited to be one of the early members of the team. You get to welcome you to Restauratology. It's just wonderful to be together. And I could not be more excited to welcome these two on the stage with us today to have a wonderful conversation. Before I give you the opportunity to get to know them a little bit more, I just want to introduce our topic and why we think it's important right now. The restaurant industry is interesting, and the last few years have not been typical. I've only been in here for 10 years, and I don't know if I've had a typical year in the restaurant industry, so maybe that's just what we do around here. But the topic of scratch made is unique because we're trying to find ways to capitalize and grow our businesses. And if you look at the traditional sources of capital that are out there, there really hasn't been a lot moving around in the last few years. There have been some, with some metrics, some historically low levels of traditional capital. And while Savory represents and works with many traditional capital providers and is an equity capital provider, there have become other sources of capital that have become available to our industry over the last little while as gritty entrepreneurs like yourselves are finding ways to continue to grow their business, even in a high interest rate environment, even in an environment where investors are still kind of reeling from some of the tumultuous macro environment we've been navigating the last few years. So I couldn't be more excited to introduce Neha and Claudia and have a conversation with them today. So let's go ahead and kick things off. Claudia, let's start with you. You've had one of the more interesting careers in food and beverage that I think I've actually ever seen in all my years here. Tell us a little bit about your background and what you're up to today at Fuku.
Thank you. Good morning, everyone. Thank you to Savory Fund for the opportunity to be here. Very excited to chat with all of you and learn from all of you throughout the rest of the day. But interesting, definitely. My background, the vertical that I grew up in was actually marketing. So early career, I was at Burger King Corporation for 8 years, pre and post RBI. So those were two very different Burger Kings and really learned a lot from both of those Burger King experiences. Middle career, I made a shift into sports marketing. So I was head of marketing for the Miami Dolphins and then for the Miami Marlins. Those are my hometown teams. They have a lot of struggles with sales. And I said, I can help turn sales and the brand with them. And it was truly an honor. But there's something about the food space that just drew me back. A lot of my Burger King colleagues had ended up at Church's Chicken, and they said, Claudia, come on back to the food space. So I did, and spent some time there. And then most recently had the opportunity 3 years ago to join Fuku as CEO. By way of background, Fuku was born of Chef David Chang. It is a spicy fried chicken sandwich concept that was born 10 years ago, in 2015, Lower East Side at Momofuku in New York, as a secret menu item. David is known for introducing secret menu items onto the menu and seeing what happens. All of a sudden, he put a dark meat, spicy fried chicken sandwich on the menu, and it sold out. David said, I have a concept here. And he created a standalone concept, which became Fuku. So by way of background, when I joined 3 years ago, the current private investment group really had run Fuku over the last 5 years as an asset-light model. So I inherited 2 restaurants, 2 brick-and-mortars, and 4 sports venues. The sports venues were a part of the DNA when the brand first started because Madison Square Garden came right up to David and said, we want you at Madison Square Garden. So long story short, joined 3 years ago, and I knew that the full potential of this brand eventually was going to be through brick and mortars and through franchising. But in an asset-light world without a lot of capital, I said, how do I grow this brand with not a lot of cash? So what I did was leaned into what the brand had been doing. We had been at 4 sports venues. It was important that I show growth and that the brand's potential had not yet been unleashed. So we went from 4 sports venues to now 20 sports venues. So while we were laying the foundation for future franchising, I had to show growth. And we took it from 6 million in sports venue sales to now over 20 million in sports venue sales. And you asked that I mention to you, share with the group, because I still can't believe it. Of those 20 million, we just wrapped up the US Open in New York. It's one of our biggest events. 20 days, $2.6 million worth of Fuku sales and over 100,000 guests served.
Wow, let's give a round of applause for that.
Thank you. And I share that because there are ways to grow your business in an asset-light way, in a capital-constrained way, and I'm excited to share some of those tidbits with you today, so thank you.
Claudia, that's incredible. You are a testament. The Savory team knows that I say this all the time, but creativity loves constraint. And when you have a constraint, entrepreneurs figure out a creative solution. So what a wonderful story. We're excited to learn the pro tips you've learned along the way. Neha, let's shift to you. You were a retailer. You founded a retail business, operated that for 7 years after your consulting start in your career. And then you decided to jump to the other side of the coin and start funding retail businesses, and many of which are in the restaurant industry. Tell us a little bit about that journey and then what you're up to today at Bonside.
Of course. And thanks, Savory, for having me here. And awesome setup, cool venue. And thanks all of you for coming in and listening. So as Taylor alluded to, my background, I started in four-wall. I was focused on building a brand called Glow Bar, which is 30-minute facials. And in building that, we did our first couple of locations through angel capital, seed rounds, a little bit of cash flows to open our next third and fourth doors. And as we thought about how do we really expand our footprint here, I was spending a lot of time on real estate and finance. So how do I find the exact leases where I can get enough TI to capitalize the build out and scale in a more capital lean way? And as I was structuring these deals, I was thinking about, okay, well, when I have a gap, when I have like an extra 100K that I need to fill or an extra 200K, where do I go for that capital? And at the time, everyone's first answer was venture capital or bank debt. And so I would go down those paths. I would be sitting in those conversations and I would be asked questions that I thought were the wrong questions. So on a bank level, they wanted to know, what's your consolidated EBITDA? What do your cash flows look like? And at the venture capital level, they were asking, what's your product line strategy? And I was like, product line? We're a services-based business. We don't have plans to do that. And so with that, I kind of thought about, well, what actually is the meat in our business? And it really was the four-wall financials. We had really repeatable revenue at our doors. We could show that we could do it consistently. So if you looked at each of our doors, each one had similar top-line revenues, similar four-wall EBITDA. And I was like, there's so much power in those numbers, and no one's really underwriting that power and financing that power. And so while I was still at Glowbar, I structured a private financing deal where I went to a high net worth individual and I said, I want to make you a growth partner of our business. And I'm going to give you a percentage of our revenues up until I deliver a set return that you're excited about. And then we're done. So you don't own any equity in the business. You don't collect like royalty fees forever. And it ended up being such an easy deal to strike that I thought, well, in the way that venture capital has been built for the tech industry, and bank loans have been built for a very different type of business a couple decades ago, could you go build an industry off of financing the brick and mortar industry? And so a couple years ago, I started Bonside, where we've been really focused on underwriting brick and mortar businesses. About 60% of our portfolio is food and beverage. We love the sector. We think there is so much power in the numbers that you all generate. And that's what I'm up to.
Awesome. I love hearing that story because anytime you see a gap in the market, you always want to align yourself with the person who tries to bridge that gap. And you've done that at Bonside. It's pretty incredible what you've been up to. Tell us how, in terms of funding, loans that you've funded, or maybe loans might be the wrong word, but financings that you've conducted on behalf of retail businesses across the country. Where does Bonside stand today?
Yeah, of course. So we've deployed about 25 million of capital across 50 businesses. We're looking to 4x that over the next 2 years. So we are scaling pretty rapidly with our deployment of capital. And the way that it works is it's neither structured as traditional debt nor traditional equity. So we kind of think about ourselves as an in-between. What we'll do is we'll look at the business, we'll look at how much revenue the business is producing today. We generally will come in when a business has at minimum 3 locations. And we will provide growth capital to your business equivalent to about a month's worth of revenue. So let's just use easy numbers. If you're generating 12 million a year, 1 million a month, we'll provide you $1 million in capital. And we're generally looking for about a 1.5x return on that capital. So that's 1.5 million back. Rather than collecting that in the course of a single year or 2 years, we actually underwrite that to about a 3.5 to 4.5 year timeline. And so the resulting revenue share that you end up paying back is around 0.1 to 3%, depending on the size of your business. And so that's really it. There's no personal guarantees, there's no collateral, and there's no kind of ownership stake in your business either. We've backed businesses like Jose Andres Group at a large level. We've backed Prince Street Pizza. We've also backed a lot of localized concepts like Joyride Pizza out in California, or on the East Coast, we've worked with Burke Street Bakery, a whole host of businesses. If you go to bonside.com/portfolio, you'll see them all.
Sign us up.
Yeah, exactly.
Thanks for walking us through
Bonside
that.
Fuku coming to you soon.
Love it. So a few years ago for Restaurantology, Andrew and I were up here. We introduced what we called the Savory Scorecard, and it's been a document that's been referenced for many years as just a way to think about how your company measures up. And today we wanted to introduce something with the help of these two, what we call our capital quadrants. And we will introduce that to you. It's a little bit small on the screen. There's a way through the QR code on the top left here, so that you have the opportunity to see a little bit more. We want to introduce to you best practices, pro tips around the different types of financing that are available to you and how to think about that. So take a minute to grab that, but then as soon as you've got it on your phone, point your eyes back here because the conversation is going to be phenomenal. So to give you some sense of a little bit of, I probably represent in this group more of the traditional financing side of the house here, with these two coming up with some of these incredibly creative ways to grow. In my history, along with the team that's here today, we've raised a little over $500 million in traditional debt or equity financings over the last 10 years in our portfolio companies. And there are varying ways that you can unpack and think through equity and debt. Those are the two most common forms of financing. Everybody in this room has a combination of equity and debt. If you think you don't have an equity investor, you're wrong. It's probably you. You are the equity investor if you don't have somebody from the outside who sits there, whether it's sweat equity, whether it's your own retained earnings, whether it's just being scrappy, or you might have used an SBA loan or some form of debt. And there are varying things that you need to take into consideration inside of that. Many of you, again, are familiar with these types of financings. And in this quadrant, you'll find some pro tips that we will share from a Savory standpoint of what you need to be aware of in terms of that. These two, however, have a very interesting view on the industry in terms of alternative financing. And I'm curious why you think over the last few years there's been a shift toward different types of alternative financing. What is it in the macro environment? What is it in our industry that's causing more of these options to arise for people in this audience to consider?
Yeah, definitely. I think, first of all, I'm excited that those exist. The restaurant business is anything but flat and normal and static. So I think traditional financing is really very static and inflexible. And in a world where, commodities are up, things are shifting and evolving every single day in this business, there are no 2 days that are the same. There are no 2 years that are the same. We, as restaurateurs, need options, vehicles that really can understand the business that we're in and not be so strict and confined in the way that the options are presented. So I'm excited about things like what you're offering and other vehicles for growing the business that are not the traditional way, because the restaurant business is anything but traditional.
Yeah. Touche. Amazing. Neha, what about you? What are your thoughts there?
Yeah, I think oftentimes when we think about this question, for us, it comes down to two things. The first is really around how operators today think about ownership. So 10 years ago, folks would say, I'm building a business, where can I go find my investors? And I think what's true today is that's not really the first thought anymore. It's, I'm building a business, how can I preserve as much ownership as possible so that that exit check at the end is mine mostly. And that shift in mentality has almost driven the operator to proactively seek out alternative options and ask questions that plant seeds in others' minds around, well, how can we actually service this industry? So that's one pillar. And then the other is the rise of technology. There's so much in the four-wall tech stack today that didn't exist 5 to 10 years ago. A point of sale system, a booking software, digital accounting records. And what all of that is doing is it's creating such a data-rich environment that it's far easier for players like Bonside to come in today and back businesses, because there's so much data for us to come in and underwrite. And that wasn't really true 5 to 10 years ago. And so you really could only use something like a traditional bank loan where there's a lot of securities and guarantees required because they can't build confidence on data.
Love that. No, and it's some of the macro environment that you're living through that's creating these opportunities, a lot of the technology, but on top of that, also the interest rate environment. And so a lot of these equity investors who are being a little bit more selective than they have been in the past. again, opening up those opportunities, and entrepreneurs always rise to the occasion. So, Claudia, let's shift to you for just a minute. Let's talk about structure. When you structure some of your license deals, again, you've done this in a very innovative way. We want to know, what are some of the best practices for the people in this audience who are being approached maybe by a stadium or a university, something that's a little bit different than just opening up a store and operating with their own employees? Help us think through structure and share us what you think are the best practices around licensing and some of those other ways that you've gone about growing your business.
Definitely, and it sounds easy, right? You just grow from 4 venues to 20 venues, but not easy really at all. And some of the advice that I would suggest is just know your brand, know yourself, know your structure, and make sure that you are able to fulfill on a licensing agreement. For example, just because you're licensing doesn't mean that you don't need to train the venue in how to properly fulfill your product. Just because you're licensing doesn't mean that you need to have mystery shoppers go out and make sure that your brand is being executed in a flawless way. Also, from a licensing standpoint, it's also, you have many different players. So those 20 different venues are all 20 different contracts. So you just need to make sure that it's not just a check in the mail. There's actual structure that you need to have within to be able to fulfill and deliver. And the margins are razor thin, right? So you really need to drive the volume within those venues to see the profits come. Another pro tip as you look to possibly expand into venues and universities, try to avoid the sports teams. And I can say that because I was on the sports team side, right? The sports team, sponsorship team, they want you to pay to get into these venues. That's kind of a new thing. When the Shake Shacks of the world, et cetera, went into venues, sponsorship team hadn't figured out that was another way to get money. So as best as possible, go to the concession partners, the Levy's of the world, the Sodexos, or there are sports teams that now understand that providing a quality food option to their guests is imperative. So search out the hospitality directors from the team side and pitch them on your idea and your concept of why it would be good to bring it into the venue. So if it's a product that is simple to make, you can turn high volume as we can with the fried chicken, and is going to resonate with fans, bring it to the concession partners, bring it to the hospitality folks on the team side, and avoid sponsorship at all sides, at all costs. I say this because, again, for example, we have a big interest in being at the Dodgers. I tell everybody I don't have Chick-fil-A dollars. The Dodgers wanted $1 million from us. I'm like, well, that's just not happening. So really try to present the product as a solution for their needs, their fan needs, and their fan scores as well. So there's a lot of tips. We can do an hour on just how to navigate the venues. Yeah.
Well, you'll be here all day, so I'm sure you'll have a lot of questions from the group, and we've got some Q&A coming up. But you mentioned one thing that I just want to ask a follow-up on. You mentioned it's still important to have a team and uphold your brand standards. How should they think about that? Everyone in this room probably knows what it's like to support one restaurant or a few restaurants, and it's pretty linear. How do you think about building a team to support a group of licenses that are spread across the country?
Yeah, and we very specifically targeted regions. We're a very small team, so we can't go after venues throughout the entire country. So we've targeted the Northeast, targeted the Southeast. So target your region to make sure that you can fulfill the needs of making sure that people are trained right. Also, be ready. At Yankee Stadium, at any stadium, you go to a Fuku concession stand. It is branded Fuku. If anything goes wrong there, I'm getting the call, not the concession partner. So also be ready from a PR crisis management standpoint. If, God forbid, a raw chicken sandwich goes out, again, the Yankees aren't getting the call, concession partner's not getting the call, I'm getting the call. So just be, it is like running, you have to be as ready as if you're running a brick and mortar, with all the solutions and answers, but you're really entrusting someone else to do it. So just have a plan and be ready and target specific geography so you don't cut yourself too short.
That's great advice. It feels like too much of an easy button. There's very little capital required for it, and it seems like, to your point, it's just mailbox money. And I think what I'm hearing from you is it's very much not that way. You have to have infrastructure. Make sure you set yourself up for success by building a good team.
And to add, this was also a strategic decision to lean into licensing because I didn't have a whole lot of cash early on. Still don't have a whole lot of cash, but I didn't have cash to grow the brand in a brick and mortar. So strategically, I said, let's lean into venues so we can show growth. But the long-term play is to continue to license, but then pivot to the brick and mortars and franchising. So that's also important. Where does it fit into your strategy?
Yeah. Love that. Think holistically. Yeah. It's a portion of your strategy, right. Not the whole thing.
Yeah.
Awesome. So Neha, shifting to you. Now, we've spent some time talking about asset light. You're willing to fund assets through your platform, and you encourage growth through that. Talk us a little bit through about what you look for, the brands that you're targeting. You touched on this a little bit, but also help the audience understand, what does cost of capital look like across the different capital quadrants that we're discussing today? And where does Bonside fit inside of that? And where should you expect alternative financing options to really fall in terms of cost of capital?
Yeah, of course. So I'll start with the first part around what we look for and how we underwrite. I mentioned when I first described Bonside that one of our beliefs was we could look at brick and mortar in a very specific way. We were going to evaluate brick and mortars for being brick and mortars. And so what that means for us is that we're generally plugging into the accounting system of record and extracting all basically GL level data. And what we're looking at is a couple of things. We're looking at your operational health, which we describe as how are the actual units performing. So we want to understand that in isolation. Let's say you have 4 locations. We want to know how each of those 4 locations are performing. But then we're also taking a look at what is the standard deviation across those locations and is there reasoning behind it. So we have some businesses that have multi-concepts within their multi-unit and there is reasoning behind why the standard deviation is high. We have other folks that are just like, I'm doing the playbook thing. I'm just going to open the same thing, rinse and repeat. And then we want to go measure that. Did you actually rinse and repeat, or is there 30 to 40% variability in top line sales or EBITDA margins? And so we get pretty granular on the operational health side. And then we also look at the financial health of a business. We know it's a CapEx heavy business. We're comfortable with that. We believe there's a good ROI to that CapEx. You generally can pay a location back in a couple of years. And so we just want to understand, have you been thoughtful about when you spend that capital expenditure? Have you been thoughtful about how levered is your balance sheet? Have you been thoughtful about how you actually finance your growth? And so we look at both of those dimensions, and then that allows us to generate our Bonside score, which actually we have, we have a slide around this. So
can we go to the next slide? Thank you.
Cool. So one of the things that we're actually launching in a couple weeks, and so this will take you to a form where you can sign up and we'll prioritize Savory folks, but we're launching in a couple of weeks the ability for any business, regardless of if you're looking for capital right now or not, to come to our platform and run a scorecard. And a scorecard is basically what I just described, and it'll share back to you exactly where your business stands. And it's an entirely tech-driven, tech-enabled process. And this scorecard is essentially for businesses to be able to measure where they fall relative to the other folks in the brick-and-mortar industry. And then should you ever be seeking capital, you will be able to access that directly through the platform. We also have landlord users that will be coming on, and so there's a whole strategy there. But I call this out because we've done this in a way that is no cost to brick and mortars, which I personally get really excited about, that we can actually give folks that visibility of how do third parties look at your business and how are they evaluating what good means. So ultimately, that's what that is. And then as far as where we think about alternative sources of capital and where that cost of capital lies, to me, the way I see it is there's 2 kind of extreme ends of the spectrum. One is traditional debt, like an SBA financing, and then the other is equity. SBA financing is likely the lowest cost of capital that you will find, and then traditional bank loans will come just after that. On the high end, equity partners have a ton of value add, and we talk about this often, but it is a higher cost of capital because you are giving ownership in the business. And so the way that we think about alternative financing is it really sort of sits in between the 2. So it's focused on having, on one side, the traditional debt and the other, the equity. If you think about the in-between, you kind of think of debt as being low single digits. You think of equity as being high double digits. You think of the alternative financing as being in between that. And so ultimately what it comes down to is if someone comes to us and they're purely making this decision on a cost of capital basis, I will tell them you should probably focus on traditional bank loans and SBA loans because that is where you will find the lowest cost of capital. But if you want something that doesn't have guarantees, you want something that feels very flexible with your business model, you want something that's fast, you want something that's easy, that's where alternative financing really comes into play. And you've seen that mature out in other industries like tech industries.
Awesome. What I'm hearing from both of you too is, again, there's no easy button. It sounds like you are still putting people through a pretty rigorous process to make sure that they're creditworthy. And so this is not a easy button financing. This is not easy button growth. It needs to be very intentional, but they can be a great partner to help fill gaps that other parts of the industry are not filling. So thank you both. Jeanette, you've joined us on stage.
So Taylor,
welcome.
what do you think? Should we hand out honorary doctorates at the end of this session?
I
feel like this has already been so good. But the audience has a few more questions that we want to dive into. When you bring in outside capital, what are the most common financial misalignments between founders and investors? And how can we as founders avoid them?
I think it's alignment around the true north. I think those things often are not aligned potentially between founders and then eventual capital investors. So early on when you're having conversations, just talk about your true north and your hope for the brand as it passes hands or continues growing. So alignment on your true north is what I'd say.
Yeah. Great.
Agreed. I think back to when I was in the operator seat, and I'm often shocked that I never actually asked an investor, what is your goal? What return do you want out of this? And I think as operators, we should feel very comfortable asking that of investors because they're approaching that conversation with that goal in mind. And so if you can establish that goal up front, then it makes it really clear, okay, do I want to pursue that goal? Mm-hmm. And then you can ensure alignment.
Is there alignment here? Right. Very good. Okay. When evaluating a brand, how much weight do you place on same-store profitability versus early unit growth? And which is more important in today's environment?
I can jump in on that one.
Let's hear it.
Yeah, this will be from the equity side as well as knowing how other capital providers look at it. So same-store sales growth is one of the most important metrics. It shows that the consumers that have walked in your restaurants that are already open are coming back, and they're either spending more with you or they're bringing people with them. That is an unbelievably important metric for any investor to understand the health of a brand. It also is a way that you can get, speaking of asset-light growth, same-store sales growth, you didn't have to build a new store to get that growth. You didn't have to take any capital risk. You got that just by virtue of operating your business to the best of your ability. That is the best form of growth you can have. That's what you should always prioritize. It's one of the absolute most important things that we look at. And very rarely, if ever, we will make an investment into a company that has negative same-store sales growth. Unit growth is extremely important as well. There comes a point where you start to think about unit growth, and you may even make some decisions to open stores where you might cannibalize some of your existing ones just to make sure that you can serve all of your customers in the best way. But that's really the only reason you would want to see any type of intentional same-store sales, maybe decline. But it's unbelievably important. It's hard to say both are important, but they serve different purposes. They have different jobs to be done.
I would say this is where it's a great example of how different financing sources have different goals. As an equity investor, I would be super aligned on that perspective. Where we actually prioritize is we can get comfortable if there isn't same-store sales growth, and we will occasionally get comfortable even if we see same-store decline, because ultimately we're not equity investors. So we have a very different anchor point of what we're looking to see happen. So when we underwrite a business, we assume that your business is going to be growing at a very moderate clip, if at all, throughout the duration of our agreement. And where we are incentivized is if you do grow, that's upside in terms of how quickly we're repaid. And so as a result, because we don't underwrite growth, we don't actively seek it. And so oftentimes businesses will come to us ahead of meeting with someone like Savory saying, okay, I know that there's an opportunity to create more same-store sales growth here or to create more new unit growth. I need extra capital in order to make that happen so that I can look a certain way when I go to Savory and attract the right equity investors. And so folks will either leverage us just before an equity round or oftentimes in tandem because we balance out the goals of an equity investor.
Right. This next question is for Claudia. How does outside capital change the way you lead and operate day to day?
So I think I don't want to go back to the true north, but outside capital, it infuses really the business, the leadership, the core DNA of the brand needs to remain. Capital is a tool. It needs to be implemented and used appropriately, but you have to stick to your plan. And I think it's just being transparent from wherever outside capital is coming from. Just, this is what the brand is, this is our true north, this is what we're accomplishing by 2030. And if it's not a fit, as hard as it is to say no to a check, sometimes it's okay, right? To say no to a check if the goals and destinations aren't aligned. So I would say, as best as possible, stick to the plan, stick to your true north. Now, if the outside capital partners have something that just we haven't thought about, then certainly entertain it and consider it. But be upfront about what the true north is, and don't let the outside capital, as tempting as it is, detract you too much from the true north.
Great. That leads into our next question. So maybe this can be 1B. How do you balance taking on capital with protecting the founder's vision and culture?
It's a balancing act, right? Yes, it's a balancing act. And I think for us, we're very honest. This is a brand created by David Chang. He stands for something. He's a brand on his own, beyond the restaurants, beyond Fuku and Majordomo. So I think the types of investors and capital that we are attracting understand that to a certain point. I think there are folks that know that when you're dealing with a founder that is a world-renowned chef, there are certain things that are going to be inflexible, and that's okay. Before I joined, and this is just even within the business, not even outside capital. Before I joined, the company had decided to remove the dark meat from the spicy fried chicken sandwich and just started doing white meat, which was a huge problem with David, right? He's like, wait, my baby was born as a thigh meat, dark meat, spicy fried chicken sandwich. So what I'm saying is even internally, you can run into those challenges. So I'd say work with people that really understand the mission, that understand that there are certain founders that are going to be inflexible, but be receptive if there are points that make sense, and have a good relationship with the founder. David and I are on text all the time, and that's also very important. You're just kind of the middle person between the capital and the founder, so keep them posted, run things by them, and have a good working relationship as well.
That's great. Anything you would add, Neha?
No, I think I would just add to that there's, I think particularly in the brick and mortar industry, because what you do is such a craft and is so specific to how you operate and what you're offering, I think there is an opportunity for brick and mortar operators and founders to portray that confidence back to investors of, I kind of know what I'm doing. And it's a little bit of my special sauce, my secret sauce. So much of what attracts my customers is not just my product, but it's my brand, it's the entire ecosystem. And I've got a hold on this. And I think that confidence can be owned.
Love that. Okay, last question. We'll look forward here. Where do you see the restaurant capital landscape shifting in the next 5 years?
I think alternative financing like fintech solutions, especially with AI now, is a factor that adds to the data. So I think fintech is going to continue to be an explosive area. Community engagement and community funding. I think that's something that we often forget. We have such passionate fans of the Fuku brand that down the road when we're ready for it, I may explore, folks that are brand aficionados, presenting them an opportunity to invest. So that's a little bit very non-traditional, but we have a lot of folks that love our brand, that are from family funds, and those are the perfect people to go after. So I think community and fintech continue to be solutions for alternative financing.
Exactly. So all of you should be on Bonside by the next couple of years, at the end of the next couple of years. No, I think realistically, the way that we see it is rooted in that. So a fun fact, the Bonside name is rooted in the bonsai tree. And the belief there is just that it's very indicative of how we perceive the brick and mortar industry, which is you can grow a small, beautiful bonsai tree. You can also grow a large, beautiful bonsai tree. And it's entirely up to you in terms of how you want to do it. And I believe that the brick and mortar industry will continue to thrive. We're in this very interesting inflection point where even as we spend time with other folks in the market, we recognize that there's a shift from these large conglomerate brick and mortars to the multi-unit emerging operators. And there is a need for capital solutions and insight solutions to better serve that industry. And so it really should grow an entirely new set of alternative financings. And while I hate to see it, I do love to see it, that we do see competitors now entering the space for us. And to me, that's the best signal that there's a lot of opportunity and growth here.
Taylor, Claudia, Neha, thank you. Let's hear it for this panel. Thank you for your information, for your time.
Thank you.